So an exchange fund works by taking, if you have a low basis stock, and you don't necessarily want to sell that stock for tax purposes, but you'd like to be diversified. So you take that fund and contribute that along with, just for talk purposes, we'll say 1,000 other investors who are all contributing separate stocks. And in return, you get the diversified basket. You get everyone's exposure there. The fund has to be held for 7 years, and there is to meet IRS regulations, there's usually an illiquid component to that. A lot of times it might be real estate for 20% of the fund, but it gives somebody who wants to diversify but doesn't want to pay the tax consequences and can afford the illiquidity, the 7-year illiquidity piece there, an option to be diversified. And it works, again, doesn't work in every situation. There's certainly some minimums that are in play there, usually $500,000 to $1 million minimum of contribution of stock, but it works very well for, I'll say the executive who has $1 million in stock they got 20 years ago, really low basis. They're retiring from the company. They maybe don't feel as comfortable with, having their finger on the pulse. Obviously, it makes sense to diversify that position, and they've built up other assets where this is really a long-term hold. This isn't something they're going to need in the next 7 years. Our portfolio management piece, is unique in that we are, over allocated compared to what I'll call a traditional advisor to alternative investments. So we spend a lot of time thinking about and investing in alternatives.
Okay.
And from that standpoint, if I take a 2020 as an example, and these are going to be ballpark type numbers, but our alternative allocation in 2020 was up somewhere low single digits, and again, depends on the exact mix for the client. But that in and of itself obviously has been a natural hedge there. So we, on the public equity side of it, we are a dimensional fund advisor type of shop. So we believe that the markets are efficient. We're not able to pick and choose individual stocks or time the market, and that carries through really to the bond piece, and also actually carries through to the alternative side there, where we say, all right, we're not necessarily looking for alpha, where we think, the days of being able to provide alpha, maybe we're there, maybe 30 years ago, 40 years ago, but it's very tough now, and when we're looking at alternative investments, we're looking for investments that have a very logical risk premium story where we're taking risk, but that risk doesn't necessarily correlate to what's happening in the stock market. So, what that leads us to, potentially, things that are off the beaten path. So we're, from that standpoint, we essentially cross off private equity. And then from a, kind of ease of operation standpoint, if a client is going to be investing in 5 different real estate partnerships, as an example, it's a heck of a lot easier to have them sign one subscription document there versus sign 5 different subscription documents. So we've have at this point 3 separate funds that we run that are under the Henrickson Nauta name, if you will, limited partnerships. We have a real estate fund. We have two venture capital funds, and this year we'll launch what we'll call a real assets fund, which the main focus there will be transportation assets. So that's been a big differentiator too for our practice. So if we look at the returns last year, our real estate fund, because our focus even within real estate is on non-correlating asset classes, we invested in affordable housing in New Zealand, which comes with a government guarantee from the New Zealand government called the Kiwi Build program. As long as you build the house, and they will buy the house from you if you can't sell it. And these tend to be multi-unit developments, but in essence, it's New Zealand government credit backed returns, but we get 12 to 15%. I think the biggest message I can send is your client's success is your success. And we've talked about this with other professionals, and we talk about it a lot internally here. And we take the success of our clients very personally. So, for a client to hand over their life savings to you is a very, very big deal. And this may sound a little self-serving for the profession, but I would put our profession, in the top three things of what is most important to an individual. You have religion, you have family, and you have money. And sometimes it's not in that order. But generally, if one of those things are not working for you, you're going to have some unhappiness within your life, and it's going to affect a lot of areas of your life. So what we do as financial advisors is very, very important, of the utmost importance to the clients we help. So to take that job seriously, and to provide them with all the available options, provide them with the expertise that you provide them with, and to do a good job for your clients will bring them success, and that will ultimately bring you success. So I think, from a personal success standpoint, any successes we have come from our clients, and it has come from client referrals. So, we talked a little bit about marketing, talked about, professional referrals. We get by far the biggest block of business we have is from client referrals. And that all comes from, making sure that we are good stewards of their life savings that they have handed over to us.